Hi guys, welcome to T Account. In this video we'll discuss chapter 5, returns, discounts and sales tax. This is relatively easy part of the syllabus, but we'll try to cover everything. And sometimes what happens is we focus more on the challenging part and lose easy marks in the exam. So if you are good in this, you can easily obtain a couple of marks because this is frequently checked in multiple choice questions of the exam. Let's start with returns. What are the returns? Returns, sales. When we make sales, to get customer loyalty and build relationship, we need to offer many facilities. So returns is one of that. You accept returns if they are not happy, they find some problems in the product. So what are the entries? What kind of entries are passed when you receive returns? For that we need to understand, let's put it in two categories, where you have one side cash sales. If you book cash sales, returns would be a little bit different. Credit sale, it will be different. What do you do when you make sales without wasting any time? Sales. When you book sales, you do cash and sales. This is the entry. Let's say it's for $1,000. Debit cash and credit sales. If after a couple of days they come and they say we are not happy with the products, there is some problem or this is not what we wanted, so please take them back. So what are the entries? You will have to pay them cash. So that is simple when it comes to return. You will pay cash, so cash credit 1,000. But you credited sales in the original entry, but here will not debit sales. Rather, we'll create a contra account, contra sales account or contra revenue account, which is called sales returns. Sales returns account. It is netted off against sales when we bring them to the profit and loss account. So we debit that account. Why don't we debit sales? It's easier to create a new account in the chart of account rather than analyzing this ledger every month or at the period end. You can easily take out a ledger of sales returns and check how many people have returned and how much it was in total in dollars. So you can easily analyze the returns and it may highlight the quality issues as well. So if you put so many things in one account, for accountants it becomes a little laborious at the closing time of. So we create another account which is sales returns. So if you book it the same thing for credit sales, what do? You instead of debiting cash, you debit receivables $1,000. Receivable to sales. That's the original entry you make when you book sales. Debit and credit. But when returns come in, what do? Simply you reverse this, but instead of debiting this sales, you do the same sales return. sales returns account to receivables, debit, credit. So that's how you deal with the returns. Same way, I mean, not different at all. The same way the purchases returns are also dealt with. Quickly run through that example as well. Cash purchases and credit purchases. At the time of purchase, you pass this entry. Purchase is 1000. Let's keep the amount same because we try to understand the concept. Purchase is to cash. You paid cash and you purchased goods for 1000. Debited and credited cash. When you returned, so what happened when you returned? We open, like sales return, we open a you open a new account which is called purchases returns. Purchases return account. 1000. So cash came back, purchases reduced against this contra purchase account. What if you do it for credit? So you had payables. Purchases 1000, payables $1000. Debit, credit. This was purchase. And at the time of return, how will you deal with it? Simply, you will debit the payables. So you are actually reversing it. 1000 debit and credit that purchases returns account. Return 1000. So that's how you deal with the returns. Let's go to discounts now. Two categories of discounts. Hopefully you are a little bit aware of that, but even if you are not, even then we'll deal with that. First of all, we have trade discounts. What is trade discount? Trade discount is basically to increase sales, to increase the volume of sales or attract more customers. You sometimes, or from the same customers, if you want to attract them to make bigger orders, you can offer them a discount in price. For instance, you can ask them, if you buy more than 1000 units, we'll give you this percentage of discount. So this is a definite decrease or reduction in price at the time of sales. So let's, say this is definite reduction in price at the time of sales. So at source, when the sales is being booked, you are aware that this is the discount we are giving. So you know the actual price, actual value of your sales. For instance, if you are selling goods, let's say list price is 1000 and you offered 3% trade discount, and it became 3970. So now you will book this after trade discount. If you are given trade discount, you will book this at this value. Let's say cash or receivables 970 to sales and finish. There is no mention of trade discount, no ledger for trade discount, no journal entry for trade discount, because you already know at the time of booking that this is the value of your sales. So there is no reduction after this. So, and no, separate account for trade discount, no journal entry for trade discount. So this is done. Keep it in mind that once you have agreed or decided to give the trade discount, after that, that is the final value of your sales. So there cannot be further decrease in that. But the second category, which is cash discount. This is something you need to understand, and different approaches, entries, you need to be clear. This is also sometimes called early payment discount, or prompt payment discount, because what is the objective of this concession? Objective of this discount is to encourage receivables, customers to pay early, because actual profit is something different, but cash liquidity issues are different. You need to have sufficient cash to run the business. If you have cash issues, you will focus more on recovery of receivables and this kind of policies. So you offer discounts to encourage people to pay early. So that's why this is called early payment discount or prompt payment discount. But this is not known at the time of, like trade discount. We were aware when somebody came and the customer booked an order for more than 1000 units, we knew that we are giving them this discount and now the value of this. But for this discount, until they come and pay, you will not know whether they are gonna get this discount or not. So that's the difference in this discount. So what do you do with that? What are the entries? Now you can have two policies for that. Generally two policies, depending on your judgment and the knowledge of the behavior of the customer, how they are going to behave. For instance, let's put them in two categories. You offer them, let's say, you sold products of, I'll write an example and we'll go through that example in different options. Sold goods for 2000, let's say $2,000, and offered 3% discount if paid within 10 days. If a customer pays within 10 days, they will get, that is your policy, they will get 3% discount. Now somebody has purchased goods from us for $2,000. Now what can we do? We need to decide on the basis of our previous experience and judgment whether they are expected to take this advantage or not. If we expect them to utilize this opportunity, then the entries are different. But if you say they are not expected to take advantage of the offer, of the given offer, then what will you do? At the booking of the sales, at the booking of sale, you will ignore that they are not expected to take this advantage. So you will book at the full value. Receivables, $2,000 debit, and sales. So you booked sales on the full value of the products. Now the other category is, we'll discuss that later. If the customers is expected to take advantage, then the booking of these entries is different. Expected to take advantage. But let's deal with this, you can say, approach first. Now once you have booked this on full value, there are two possibilities. Either they can come and pay early, or they will come after 10 days and pay full amount. Now if they come, let's say on 30th, after losing this opportunity, so if they do not take advantage, as per our expectation, do not take advantage, what are the entries? Simply you will receive cash of 2,000 and receivables of 2,000. Finish. As simple as 1, 2, 3. What if they unexpectedly come on 9th? You sold on, let's say, 1st of January, and they came on 9th and they paid. Then what will happen? Now you cannot ask them for $2,000. You will have to accept 970, which is that, you will have to accept 2,000 minus 3%. 2,000 minus 3%. How much is that? 60. 940. So if they come on this and they pay, you cannot ask them for 2,000. You will have to accept this cash, 940, and you will have to credit full receivables, which you booked at 2,000. Where does that difference go? You have to debit something. What is that? This is discount allowed. Now that is your additional expense because this is reduction in revenue that you have already booked as per your judgment and policy. Okay, this is an expense account, discount allowed. Now let's do the same thing on this judgment, this policy. You expected that the customer will take advantage and you booked sales like this. Receivables on say 1st January. Receivables of 940 after discount. 2000 minus 3% discount. Receivables to sales. Clear? When you expect the customer to take advantage of the policy of the offer you are making to them for cash discount, you will book it like that. You will book the net amount as sales because you think that that is the revenue you are going to receive. That's your best judgment. But again, there are two possibilities. Either they will come on, let's say, 9 and say, here is your cash. So you will take cash of 1940 and credit receivables. And done as per expectation. No problem. But there is another possibility. They do not come on or before 10th, they come on 30th. They come on 30th January and they try to pay you. You will not accept this. You will get cash of 2000 because they have missed that opportunity. But you have receivables of, you will get cash of 2000 but you have receivables of 940 in your books. Where does that amount go? The difference. Where will you put the difference? Difference you will treat like additional sales. You are making additional cash sales at the time of payment. So you will book that sales. How much is that? 60. So that's how you will treat that situation. Okay. Now just a recap. Trade discount is not recorded separately. This is the definite reduction in price at the time of making sales. So there is no separate account, no journal entry. What is the objective? Objective normally is try to increase the volume of sales, get more customers, bigger orders. Whereas cash discount or other names for that discount are prompt payment discount or early payment discount. This is the discount that you make at the time of receiving the payment. And this is used to encourage customer to get early payment, increase the recovery and reduce the risk of bad debts and other things. Okay. And the entries are like this. When you are dealing with cash discount, you can make two policies. On the basis of your past experience, based on the behavior of the customer, you can judge whether he'll take advantage, he will pay early or not. If they are expected to pay early, then you will book the net amount. You know that they are going to get this discount, so you will book the net amount. And if they pay on time, of course, the same entry will go through. But if they come late, don't pay before 10, the difference, the discount you have already booked, that you will add sales, book as additional sales. But where does this discount go? Where is the difference? Because it was 2000 and here you booked 1940. This is just like trade discount. No entry for that. Because at the time of booking the sales, you had an idea and you knew that you are going to lose this. So, we'll treat it just like trade discount. Now, let's do a quick example. I wanted to do it here, but I think I'll have to clear it. I needed this data to be here when I go through that example, but I'm not sure if we can cover all that on this board. This example is, where is it from? It's from chapter 5 on page 77. I have a screenshot here. I don't want to open that book again and again. Now, I'll read it for you. One guy, George, he has receivables and payables both. And this guy is saying, George owes a supplier, Herbie, $2,000 and is owed $3,400 by a customer, Iris. George offers a cash discount to his customers of 2.5%. Now, let's keep noting the relevant information. We are making the books of George, this guy. Now he has payables of $2,000. Okay, and receivables of $3,400. Okay, now George's policy is towards his customers, offers a cash discounts to his customers of 2.5%. 2.5%. When is this offer valid? If they pay within 14 days. If pay within 14 days. So that is George's policy. What is Herbie's policy? Herbie is George's supplier. It says if they pay within 14 days, and Herbie has offered George a cash discount of 3%. 3% if paid within 10 days. Not sure if they are, but I'll solve it here so you will know what is going on. Okay. Now this is the information. George has payable and that supplier offers 3% discount if paid within 10 days. And George himself offers his customers a 2.5% discount if they pay within 14 days. Now, what actually happened? George took advantage of that early settlement discount offered and paid Herbie within 10 days. George paid within 10 days and got the discount. Iris was expected to take advantage of the early settlement discount offered to her. And meaning he is trying to tell you that And in every question they will plainly tell you that what is the expectation from that customer, whether he is expected to pay within that time limit or not. Now they are saying that IRS was expected to pay this within 10 days. IRS was expected to take advantage of the early settlement discount offered to her, and therefore the sales invoice raised by George was prepared on that basis. However, IRS did not pay within 14 days and paid the full amount after 30 days. She didn't take that advantage, the second side of the possibilities we discussed. Now, what is he asking from us? What ledger entries are required to record the payment by George to Herbie? To, let's say, this is a purchaser's perspective. Part A of the George, what ledger entries are required to record the payment by George to Herbie? Now, Herbie is his payable, and he had 2000 payable. Total payables $2,000. Okay, let's say the price, the invoice price. Now, he offered how much? 3% discount if paid within 3 days. 3% discount. First, we'll figure out how much is the net amount, so that whatever is the possibility, we'll deal with that. 3% of 2000 is 60. Net amount is 1940. Now, instead of paying that, I missed that purchaser's perspective when discussing the discount. But to keep it simple, purchaser will record it at the full value, and if they pay early, they will then deal with the difference. I'll discuss it here, and that will be discount received for the purchaser. If he pays early and gets that discount, that is discount received, and this is an income for them. Now, because it is coming in this example, so I needed to discuss here. Now, they booked it, for instance, at the time of sales, purchase, they booked it like this. Purchase is 2000, two payables, Herbie, 2000. Okay. Now, they are getting that discount. This is purchase at the time of purchase. Now, at the time of payment, they are paying within that time limit. Now, they will not pay that full, that George will not pay the full amount. He will pay only 940, and full payable will be cleared, payables 2000. Okay, and the cash is reducing by only 940. Where does the difference go? Of $60. This is discount received, which is an income account for the purchaser. Now, this is purchaser's perspective. Okay. In part B, what is he asking for in part B? Now, this is part 1. Part B, these are the entries which will book in the books of George for Herbie. What accounting entries are required by George to record the receipt from Iris? Iris customer. We have receivables of 34. Okay. And although invoice price was this, but we expected that Iris will pay early and she will take advantage of this. Discuss. So, list price was, or invoice price was this, list price First we need to get to the calculation. And 2.5% discount. Net how much? Minus 34. 3315. Now I just discussed that if you expect the customer to pay early and take advantage of that offer, you will book the net amount as if you are sure that they will get that discount. Now, as per their expectation, George must have booked this amount and not this, because they were expecting Iris to take advantage of this discount and pay the net amount. So they booked receivables of 3315, sales of the same amount 3315. Now what happened actually? She didn't take advantage. Instead of coming before 10th, she came on 30th. Let's say 30th January, and she paid that amount. Now she will not pay 3315, rather she will pay the full amount. So George will receive cash of 3400, whereas he has the receivables of only 3315. Where does the difference go? Difference is additional sales of how much? 85. George will consider it as an additional sales at the time of payment. So that's how we'll deal with that. Customers, this is purchaser's perspective and this is seller's perspective. Hopefully this has helped. Go through this stuff several times. If you are comfortable with this, you can get easy marks during the exam, because this is not that tough, but we focus on challenging things more and spend more time on those topics, so we miss easy marks. Thanks a lot for watching, and if you are interested in previous videos, I'll put them in the description. Thanks a lot.